FM 89.3, Singapore's most influential radio station.
You are indeed in the Breakfast Huddle with me, Manisha Tang.
Good morning. This is your finance news with me, Ryan Huang.
I'm Michelle Martin. Good morning.
Good morning. I'm Adrian Abraham.
I'm Clarissa Monter for the Workday Afternoon.
This is Prime Time on Money FM 89.3.
I'm Rachel Kelly.
Tuesday was a good day for markets.
Weekend mornings here on Money FM. Glenn Van Zutten with you.
Money FM 89.3.
Hello, welcome to Money Matters, and this is a special webinar series that we are bringing to you to help you with your personal finances. And this is actually a continuation. It's part 2 of what we left off last week, where we talked about CPF, how and why you should be investing your CPF. And today we are talking about the planning for retirement with your CPF and your other life goals. And today we are bringing back Ivan Guan. He is an independent financial consultant and also the founder of sgmoneymatters.com and also the author of Fire Your Retirement. In fact, we are giving out his book today to 2 lucky winners. And if you want to win his book, just leave your comments and questions in the comment section. So we'll be picking some of the interesting answers and comments that we feel are going to be giving us some food for thought and also conversations to last us for the next 1 hour. So we want you to be part of the conversation. So leave your comments, and just to start things rolling to make sure we have everything working, can you please answer the question on your screen right now? Have you started investing for your retirement? So that is a question. So if you have started investing, please type yes and maybe what you invested in. So that give us an idea if our chat function is working right now as well and you can hear us clearly. Hi, Chris. Thanks for joining us again. And while we wait for the questions to come through, let me run you through the usual disclaimer. All information you are hearing today is just for your information only, for your educational purposes. So if you want specific investment advice for your own specific situations, you need to find your financial advisor. So this is something you need to take note. Today's session is just for educational purposes. Of course, we want you to also share this video if you like what you're talking about, like it as well, and share with your friends, tag it on Facebook so that more people can learn and also be able to plan for their retirement. Now let me bring in Ivan to the conversation. Ivan, how are you doing?
Hi, Ryan. I'm fine. Good afternoon, everybody.
Now, Ivan, we are, of course, 1 week after part 1. Maybe you can just help us recap what we went through last week.
Right. Maybe I will start with the slides and I will recap some of the things that I mentioned last week. So some of you are already come back for the second part of the webinar. And I will just briefly recap what we have talked about last time. So for the benefit of the newcomers, for those people who are not familiar with me, as Ryan mentioned that I'm the founder for IG Money Matters, and I'm also the book author of Fire Your Retirement. This is the book. And I'm a fee-based investment advisor specialized in retirement planning, especially for early retirement. I'm also a qualifier of $1 Million Roundtable. So in this seminar, I will talk about a few things. There are 2 things we are going to talk about. The first thing is I will focus on retirement planning. And then the second part of the seminar, I will focus on investment planning. So retirement planning and investment planning are 2 separate topics. So I will first of all recap what is the role that CPF play in our retirement planning and how much CPF should you invest and what happened to your CPF if you pass away. This is something that the people often overlook. And the second part, I will talk about investment planning with CPF. What kind of risk and return should you expect from investing? This is a question I got last week. I promise you I will address this because a lot of people are interested in investing, but probably you are worried about the risks and you don't know what kind of returns can you expect from investing. And I also talk about why traditional way of investing doesn't work well. Many of you have invested before, but probably that didn't work out very well and you give up investing. And what is my recommended way of investing? This is I'm sharing my experience with 15 years of managing people's investments, and hopefully that will be beneficial to you. And before we proceed, I encourage you to join my Telegram channel, which is Fire with Ivan. You can use the link, or you can use your phone to scan the QR code. And then you are able to ask me questions if your question is not answered through this webinar. Okay, so I just recap some of the things that I actually talked about last week. Before we're talking about financial freedom, we need to understand what is financial freedom under retirement. So each of us, we have this human capital when we start working. Our future earnings is our human capital. And it is normally when you're younger, you have a more human capital, and when you're older, you have less years of working. Your human capital reduce. But at the same time, we build up our financial capitals, which is this line. So this line is our financial capitals. The retirement comes when your financial capital is able to replace your human capital. So this thing you must remember, because a lot of people want to plan for retirement, but you actually do not have a good idea about what it means financially. So it is when your financial capital more than your human capital, you are able to call it for a retirement. So essentially, you can summarize financial freedom means passive income is more than your expenses. And I have this diagram in my books. Essentially, what happened is that when you are working, this is your current state. You have an earned income and you have expenses. And most of us will have some savings per se. What you need to do is during the year of working, you need to accumulate income generating assets for the purpose of the retirement. Income generating assets can mean, for example, stocks and shares, insurance products, your CPF, and even your properties. All these things will eventually generate passive income after your retirement. And when passive income is more than your earned income, it's a time for you to retire. Retirement doesn't mean that you don't need to, you cannot work. You can still work, but just that you choose, you can choose when you work and when not. I heard about this thing recently, which is very interesting. They say that if a person is rich, the lowest level of rich is that you can do what you want. But the highest level of rich means that you can choose not to do the thing you don't want. You can think about that. And then the CPF actually play a very important role post-retirement, which is what I call the guaranteed income in my book. Because when you retire, you have a different source of incomes. And some are guaranteed or say more predictable. Some are more volatile or the less predictable. So you need to have a guaranteed income, variable income, and a bonus income. This is a 3-layer of income that will replace your earned income. And today's topic, we focus on talking about CPF, but actually the same principle apply to all other incomes. Later, I will explain to you how you can view your CPF from a financial point of view. So I will zoom into this thing. Will be a bit detailed. Will be a lot of a bit technical, but I hope that this will give you a good idea about what is happening, because this is through my experience of planning for many people. A common asset allocation of a Singaporean is something like this. Okay, most people, you will have some cash and you have some fixed deposits, and it's normally not a large amount of money. And a lot of people actually have properties, and you may have some insurance, you have a bit of stocks. And in this category, when we view about CPF, we actually can view CPF as a long-term bonds. Essentially, a CPF is something that is like a fixed income. And let's say, for example, they give you a 2.5% interest or 4% interest. This is a long-term interest you are getting from the bond. So in my way of financial planning, I always view CPF as a bond. So this is how you can structure your asset allocations. So a lot of people use CPF to buy house. That's why you won't typically have a lot of ordinary accounts, but you may have a lot of special accounts. and the money actually pour into the real estates. Is some funded by cash and the CPF together. So if we were to chart this thing, right, you can see that this is how most people's asset allocation we call. Asset allocation means how do you distribute your assets. Most people, I can see that you will have a lot of in the properties, and second largest asset for most people is actually CPF as well. Some people have some investment here and there, but actually the absolute amount of dollar is not a lot. This is what happens now. And I just want to quantify some of the things I mentioned here. First of all, for property, right, when I calculate, you should calculate based on the net value, not the value of your property. So for example, if I say 600,000 here, it actually means the property is worth maybe let's say $1 million, and then you already pay off some. And this one we are talking about is the net value, because the loan itself is not your assets. So I hope that is clear. Later, if
yeah, Evan, I just thought I would jump in here and pose a question to all the viewers. So one of the questions that has been coming up is, how do you invest in the markets right now? And we want to ask you, what is the biggest challenge you face with investing? So if you have any thoughts on this, please put it in the comments, and we'll get them answered and address them during the break that's coming up later. So once again, the question: what's the biggest challenge you face with investing? Yeah, Ivan. So that is something a lot of people have been trying to grapple with what's happening this year. We've got so many changes, and I think it's going to be interesting to see how people can leverage CPF to plan not just for retirement, but also for their investment needs.
Yeah, sure. I will address this question later. Yeah. So I'll just move on for this part. So, okay, this is the common asset allocation of common Singaporean, right? And the next thing that I mentioned last week is that if you want to be rich, you need to do what the rich people do. And if we look at how global millionaires, they allocate their assets, it's quite different from what we see the chart previously. So just now they see the chart is like this one is quite lopsided. Majority in the properties, CPF, and the bond savings, safe assets, a little bit in the stocks, a bit of in cash, and some other insurance. But if you look at what do the millionaires do, right? They actually have at least 1/3 of them into stock markets and fixed incomes to balance it out. And the real estate is actually a smaller portion of their entire net worth. And for the cash and the cash equivalent, last week, someone asked me why the cash is so much. I want to explain to you, when we're talking about cash in financial terms, it's not necessary to say it's a cash saving in the banks. Cash and the cash equivalent, we can referring to anything that can be liquidated very quickly. For example, your fixed deposits, for example, your short-term duration bonds, things that you can liquidate within a year. Then normally they will put into the cash equivalent. The reason that the rich people normally have this amount of investment because these are the things that they can buy when opportunity comes. For example, in March last year, when the stock market crashed, and a lot of people actually take the opportunity to reallocate their assets through such period. So you need to keep a fair amount of cash into your total portfolio as well. So when we're looking at how do you plan for your retirement, you always go back to this drawing board. So you need to look at your entire net worth, take a checklist, see how much do you have in the stocks, how much into managed portfolios, how much in the real estates, and how much in alternative bonds and cash. Do a balance. The more balanced you are, the better you are equipped to weather any tough period in the future to come. And after you identify the right, we need to identify what kind of return you need to. Why we say that, I'll go back to this one. I think I should mention it. I highlight this portion, which is 2.28%. Why is this important? Because a lot of people, you may invest in something and you think you have already invested, but you need to see what's the impact of your investment to your entire net worth. if you only invest in a small amount of money, even if they give you a good return, let's say 10%, even 20%, if it's a marginal impact to your entire net worth, then you need to do something about it also. So you see, in most people, if we look at the average return of your entire net worth, it's actually 2.28%. That means that your financial assets, just now we're talking about the financial capital, is only growing at a 2.28% rate per year, even if you have different source of investments. So that is not very ideal. This is not very ideal. Sometimes it can't, let's say if the inflation really kicks back, and this can't even beat the inflation. So when you're looking at the retirement planning, you really look at the rate of return for your entire net worth, not focus on particular stocks or particular investments. So it's a bit complicated to determine how much is your rate of return, but I can give you a general idea. The general idea is this. You need to identify, first of all, at the time of your retirement, how much income generating asset you need to have. You remember just now I mentioned about you need to build up these retirement assets. And then they can be composed by different layers, which is talking about different source of income. But ultimately, you need to reach some stage like this. And then maybe now you are somewhere around here. So your wealth actually grow in this path. And then your rate of return actually determine how fast you can reach this one. For normal people, if let's say you want to do a normal retirement, maybe you don't need a lot of rate of returns. But let's say especially for the people who need to have an early retirement, that or you are very near your retirement age, let's say in 10 years time, you need to focus on a good rate of return. So you need to determine is your rate of return 2%, 5%, or 10%. And from then you do your asset allocation. So this number is very important. Before you do any investment, you need to determine your rate of return. In the second half of the webinar, I will explain more about this portion, but just take this number as it is. So for example, if we determine that your rate of return for your entire net worth is to grow at a 5%, what do you need to do? So we can do some adjustment with your current holdings. So first of all, a lot of people, their biggest assets is in the property. Okay. I'm not saying property is no good. It's about how much you want to allocate. Of course, if you have a lot of cash savings, then it's not an issue at all. You know, it just the relative percentage of the property is not huge. But let's say if you are in this situation and your wealth is not growing at the speed you want, you may want to do something about your properties. Okay, I assume that the net value of your property is half of your property's current value. So for example, if just now we see it's 600,000, I assume your property is $1.2 million. But let's say if your property is 600,000, which is very affordable for any good HDB or even a smaller condo, right? Then your net value of the property maybe is 300,000. And in this situation, we actually free up 300,000 financial capitals. The 300,000 can actually go back to your CPF, OA, and it's also part of the go back to cash. So I assume, let's say half. And when you have this allocation, you reshuffle your asset allocations. You actually rebalance the way that how much you want to invest. And you probably can achieve an average about 5% rate of returns for your entire portfolio. And your portfolio will be something like this one, which is much more manageable. You don't need to understand the details about these numbers, but I'm trying to give you an idea about how retirement planning should be like. A retirement planning is not to say you need to find a new job or need to earn a high income. Retirement planning is more about looking at your existing financial assets, reshuffle them to increase the rate of returns, which I call the ideal asset allocation. So if you have questions about this one, later I can answer a bit, but just take it as it is. So we jump from a very big allocation to lopsided asset allocation to a more balanced one. And then you increase your rate of return for your entire portfolios. So essentially, as I mentioned, right, retirement planning is about optimize your financial resources, which is your financial capital. Yeah, of course, if you are able to increase your human capital, means that you can earn a high income, you can find a second source of income. That is all good. But the immediate thing you can do is that to optimize your financial capitals. And there are three things you need to bear in mind. The first one is that you must diversify your income, not just based on one asset, and you need to maximize your returns, and also minimize the risks. A lot of people say high risk, high return, low risk, low return. It's actually not true in today's environment. Later, I will explain in the second half. But you need to bear in mind that your objective is to earn the maximum return with a minimal risk. This one must be in your mind when you do retirement planning. This is maybe a bit technical, but this is thing you have to go through. And if you find it's very daunting, very difficult to engage a financial planner to help you to do that. I mean, you don't necessarily have to look for me, but find some professionals to help you, and you will be able to accelerate your path for the retirement planning. Okay. Then the last thing I just want to briefly talk about the impact of a CPF investment when you are no longer around. Because retirement planning is something that you cannot escape from estate planning as well. Because ultimately, all this is your money, and they will be passed down to your generation, next generations. So you need to understand how your CPF is distributed to your beneficiaries. First of all, CPF savings and I use CPF Life Premium, you are able to do a CPF nomination. So if you haven't done so, you should just download the form from CPF website. You can able to do the nomination. And most Singaporean will have this dependent protection scheme, which is the insurance managed by Great Eastern or NTUC Income. Do an insurance nomination to name your beneficiaries. But property bought using CPF savings and the investments, you invest in stocks and ETFs, all those money cannot be nominated. So they will be covered by the will. So you do need to have a will as well, which is all very manageable, but it's a small matter that the people sometimes they don't overlook. And imagine if you have 1 million CPF savings and if you didn't do a nomination, the thing can be quite messy if you pass away unexpectedly. Okay. Before we go to the second part, I want to share a story. This is a story I share in my books as well. I want to talking about a story about yacht. Some years ago, I met one client. This person is British, and we share a lot about retirement. He's 50 over years, and he told me that his biggest dream was to own a yacht. In fact, his passion about yacht started like something like 20 years ago, and he's a very expert in the yacht. He knows how to sail, he knows how to repair it, where to get the best resources for the yacht, everything. But the only thing is that he told me that he never bought one because he was busy with his business, and he hoped that one day that after the business is settled down, then he's able to fulfill his dream. And he said that just before he met me about a couple of years ago, then his mother was very sick. So he has to fly back to his hometown to take care of his mother. And that's a time that he realized his entire business is falling apart. At the same time, his life is also falling apart. At the end of the day, after his mother passed away, he came back to Singapore. And that's the time he started thinking that if he should get a yacht. So we talk about it financially, we do all the plannings, everything sounds okay. But later he shared with me there was one issue because he is probably too old to sail a yacht. For us, maybe a lot of people are waiting about yachting is that you sail around Singapore in the smooth water. But his passion is to sail across the continent to other countries. And that you need a lot of physical strength. And I don't know whether he has a yacht today, but this is a thing really triggers me. And that's one of the reasons I wrote the book as well. I want to share with you. Because when you do retirement planning, it's not just financial planning. You need to do something which is in line with your life stage. retirement planning essentially is a life planning as well. This is very important because even if you have the money, you may not be able to do the thing that one day you want to do. So you need to plan your retirement together with your life goals. That is the point I want to drive to you. And I hope that give you some inspirations as well. Lastly, so I just recap that if you have anything later you want to ask me again, do join my Telegram channel, and you can ask questions over there as well. Yeah. So I think we can probably move on to the Q&A for the first half of the session. Ryan, I can't hear you.
Yeah, it's great to see so many interesting comments coming through. Thanks for sending in your comments and questions. Ivan, thanks again for part 1, retirement planning with CPF. And so far, we do have a couple of good questions. And let's start things off first with Chris. My biggest challenge is how to diversify my portfolio, both geographically and also across asset classes, so that it can be balanced and resilient. So this seems to be a very common challenge, Ivan. How do you navigate this landscape right now when things are so volatile? Because the asset valuations can move up so fast, and then suddenly your portfolio is not balanced anymore.
Yeah, this is a common question, but actually, it's the easiest problem to solve, because a lot of people, they are not aware they actually can invest globally and in a diversified portfolio fairly simply. Because most people, when they start investing, their stockbrokers or their traders, they tell them, oh, you can buy this stock, sell that stock, and the majority of them are focusing on Singapore stock market as well. In my review, I review many people's investment holdings. This is called the home country bias. You tend to invest in the thing that you are most familiar with, right? You like to buy, you rather buy DBS shares than Goldman Sachs shares, right? You want to buy Singtel than some other countries, China Mobile, whatever. So that is called a home country bias. But in reality, today we are in the best time to invest because we have the tools and the resources that in 20 years ago is not available to retail investor like us. Last time, when you want to have a global diversified portfolio, you need to pay very expensively to the investment banks, and they charge you a very hefty fee to manage your portfolio. But in today's context, this is very, very easy. You can get an ETF, you can get a unit trust. Just one fund can have maybe 1,000 stocks underneath, and diversify your portfolio. Yeah, with just a few $1,000s can do it.
Okay, so diversify across stock markets as well, geographically and sectors, and this can be done with unit trusts, ETFs, and these are something that you can tap on using your CPF investment resources as well.
Yeah, correct.
Okay, we have a question coming through as well, and this one is from Jim Tan. In short, how do you choose your financial consultant? Because there are so many out there charging different rates. How do you identify which one is a good one? And of course, they make a lot of projections. How do you make that assessment?
Okay, this is a fairly common question as well. So first of all, this is my suggestion to you. When you're looking for a financial professional, you need to look for the financial professional have the same financial objective as yours. Let me elaborate. So let's say, for example, if you are a pre-retiree and you want to invest for your retirement, when you talk to a young chap, let's say a fresh grad, or maybe some investment traders who like to speculate, they may have a different life stage and a financial objective than yours. It's not saying that they cannot do their job well. It's just that they don't have the same mentality as yours. For example, maybe your objective is to preserve your wealth, moderate return, peace of mind, less volatility. But for people who are in a different life stage, they may be more aggressive in growing your wealth, or maybe more in terms of speculative and tradings as well. So first of all, my advice is that you need to get a person who have the similar life stage and the financial objective as yours. So, for example, I only do investment for retirement. I only my clients are mostly the people who have the same objective as mine, which is we are all investing for our own retirements, and that is the thing that we have a alignment of the interests, and also that in terms of making positive returns and history doesn't guarantee future performance. That is very true. So the second thing, you need to look for someone who have an investment strategy that you agree upon. That means that the person can have a very good strategy. For example, people may want to invest in Bitcoin. Maybe this person is a cryptocurrency expert, but does that suitable for you? You need to ask yourself. So you need to find a strategy which you can personally accept and take comfort with. So just to summarize, there are two things. First of all, look for an advisor who have a similar life stage and a financial objective as yours. The secondly is that you need to find an investment strategy that the person use, which is you can take comfort with.
Yeah. I also get this question quite commonly as well. Should you actually look for a more experienced and maybe older financial consultant because they've gone through so much and maybe can share more from their life experience? Because some financial consultants have not even been born when the Lehman crisis situation happened. So it's a very interesting question to ask because everyone is looking for different things. When you're younger, you also are more exposed to different things. So it's a good question to ask, and also something you should always try to figure out the life stage, whether your values are aligned as well, whether it's chemistry, so you can open up your situation more to your consultant. And a question coming through from Haja, I suppose risk management for all kind of investment is equally important. So is there any advice when you talk about risk management for investments that you normally give to your clients, Ivan?
Okay, risk management is actually a very difficult topic. That's why most people do it wrongly. The thing is that because most people, when they're talking about investments, they always focus on returns, right? So when people ask, hey, which stocks is good to invest, but they never ask which stock have a better risk-reward ratio. So typically, people focus on the returns in terms of risks. Managing risk is not easy. Actually, your financial advisor or investment advisor, they are the best person. Their main job is to manage your risks. Because in the good market, right, everybody is a genius. Everybody is a genius in the good market. So let's say the stock market is very good for the past 6 months. Everybody, as long as you invest in something, you can make money. But the difference between a good advisor and the not so good advisor is whether they are able to predict the coming risks and able to manage your portfolio exposure should such thing happens. So this is the thing that you need to take note of.
And Ivan, here's one on inflation. How do you find places to invest in which can beat inflation? Are there any ideas you can share with the viewers where to look for to get inflation beating returns?
Yeah, actually, not long ago, I wrote an article about the upcoming inflation crisis. At that time, I wrote it, I think, about November last year. I talking about that there will be a huge inflation coming due to the COVID, due to the money printing, all these things. At the time, not many people talk about. I think inflation in the recent months have been a topic that the people start to take note of. I want to highlight to you that every inflation is different. Every inflation is different because we need to understand the inflation, is it caused by cheap money, or is it because of a supply demand disruption, or is it because they call the stagflation. So there's a different way of different kind of inflations we can face in the history. So you need to adjust your portfolio based on what is actually happening. So in today's context, I would say that first of all, bonds is very difficult to beat inflation because of the low rate and the hiking interest rate environment. And even there's this thing called inflation protected bonds, which is largely US, may or may not be able to do it. I would say that the best way to combat inflation in today's environment is really stock market. That is why you see the stock market has been so bullish for the past 1 year, because the stock market already knew inflation is coming, and that is reflected in the asset price as well.
Okay, so in main stock markets, are you looking more for dividend type of paying stocks or growth stocks?
That is another tricky thing that you need to look at it. So there's no such thing to say which stock is good, because as I mentioned, right, the inflation, every inflation is different. So I just expand this topic a little bit. Maybe I can read an article about it later. So let's say when inflation happens, a lot of things can happen. For example, let's say now we're talking about, let's say, inflation. So would the central government start to raise their interest rate? So whether they raise their interest rate or they don't raise their interest rate have a different impact to other financial assets. They'll impact your stock valuation. They also impact your property price. In the long run, right, of course, growth stocks are the best combat for inflation, because growth stocks, we're talking about future growth of the company. Growth stocks, because of the current environment, is very volatile. Because of the high interest rate environment, rising interest rate environment, we will have a devaluation of the growth stocks. So in the short term, maybe the dividend stocks is better, but in the long run, the growth stocks will be better. So you need to see like which investment stage are you in.
Thanks, Ivan. So once again, please keep your questions coming in, and we promised you that we will be picking a winner from the comments for the prize that we're giving out today. 2 books from Ivan, Fire Your Retirement, and we are going to announce the first winner right now, and he is Jim Tan. Jim, thanks for sending in your questions. In fact, you sent in a few questions, all very good questions, and everyone has been sending in very interesting comments as well. Please keep them coming. We have 1 more book to give away. So Jim, you are walking away today with a book from Ivan, Fire Your Retirement. So I think that will help you really to plan what to do next with your CPF funds and also how to plan for your retirement. So once again, keep your questions coming in. We have 1 more book to give away after the session ends. And Ivan, I'll hand over to you to walk us through part 2, investing with CPF.
Okay. Congrats, James. So I will move on to the part 2 of this webinar, which is talking about how to do the investment planning. Investment planning is not only useful for CPF investment, it's actually useful for any other sort of investment. It can be extended to your cash investment and the SRS investment as well. So I will talk about 3 things mainly: what kind of risk and return should you expect from investing, and why most people fail in their investing, and what is my recommendation of investing. Okay. There are many ways of doing. I'm sharing my experience that throughout the years, which is the best way I think retail investors should use in terms of investing. So first of all, before we talk about investment, you need to understand your life stage. As I mentioned, you need to understand, are you before retirement or post-retirement? And your investment objective, is it more for growth or more for security and income? So the way of investing will be different. As I mentioned last week, that you can invest in all sorts of things in the CPF. So it's not limited to Singapore shares. You actually have a global diversified portfolio through, for example, unit trust as well. And these are the things that you can actually invest. And I mentioned that it's all about risk reward. You need to be able to maximize your return with a minimal risk to take. So in order to understand this concept, I want to explain to you what is called expected return. This is a professional term, but if you can understand it, you can make a better decision. It's also help you to choose the right advisor, because if the advisor is able to understand this concept wisely and able to advise you accordingly, they will help with your investment as well. Okay. So expected return means that the amount of profit or loss that you can anticipate receive in the investment. So that means that you have a reasonable assurance that you will get this kind of return if you invest in something like that. And but of course, nothing is guaranteed. So there's odds of occurring. Some investment have a higher chance of achieving certain returns. Some investment have a lower chance of achieving certain returns. And this normally based on historical results, and the return is not guaranteed. So let me give you an example. For example, bank savings. If you put your money in the bank, you get about 0.05% returns. We're talking about the odds of guarantee is almost guaranteed. 100% odd, right? And the CPF OA, you get 2.5%. This is your expected returns. And CPF SA is 4% expected returns. These are all almost guaranteed. It's a high odd. But when we invest, we deal with bonds, properties, and the stocks. These are the things which is not so certain, So how do we understand this? So I want to explain to you in this graph. This one is called risk-return trade-off, which is typically used by professionals. It's a bit complicated, but let me just use a simple way to explain. You have two axes. This is volatility representing the risks. This is talking about the returns. This is talking about if we were to invest in something, what kind of return do we expect for the next 10 years on annual basis? And common sense will tell you that you should look for something in this zone. That means that you have a maximized the return, but with the lowest risks. So if something invests in this zone, you have a high return, but relatively low risk. If you invest something in this zone, it's not going to be very good for you because this zone have a high risks, but lower return. So you just remember in this kind of graph, you are looking for something over here. So somewhere over here is the best. This is called regression line, but just to statistically put everything together. So you realize actually that there are things that you can invest over here. This is in 2015. So in 2015, let's say I want to have something just now I mentioned 5% return. Actually, I can invest. Okay, maybe I just highlight the color code. So the green color is referring to bonds, different type of bonds. Blue color referring to stocks, and the red color refer to alternative assets. Alternative assets, for example, like commodities or physical real estate or private equity investments. So this is how you see. You see, in the past, right, you actually can have a decent return if you have a bond portfolios. You don't really need to have a stock portfolio. You don't need to expose yourself to so much to stocks. You can have a little bit, which is enough. This is 2015. If you look at the next graph, this is 2015 comparing to 2019. You realize actually all these returns have been shifted from the original position. So why am I saying this one? Because the expected return, as I mentioned, is based on historical data and it's keep on changing. So sometimes people say, oh, I want to invest in something, this thing give me a good return. It's actually referring to the past. But as all of us know, past doesn't guarantee the future. So even if something was expected to be here, they can move into other place. For example, you see the bonds. A lot of people invest in bonds last time for retirement, but you see the bond have a very lousy risk-adjusted return. This is very simple because of the ever decreasing interest rate environment, which make the bond very unattractive. And you see the stocks actually doing a better job for this period. So stocks will have a better return with a relatively low risk. So that's why I say that last time people say high risk, high return, low risk, low return is no longer true. Because last time people perceive bonds to be a good inflation hedge, also with a low volatility, which this doesn't happen anymore because of all this world quantitative easing, all this change of money printing environments. And if we look at what happened in 2019 and 2020, which is last year, the pandemic itself also changed everything. So you see the whole graph have been shifted from 2019 to this one. And this is another very different things. And you realize that, oh, actually, some of these stocks have been moving to an even better. So if you were to invest in stocks last year, you will have the best performance ever because there was never such a good time to invest stocks for the last year. But 2020 is over. Now we are in 2021. How is this graph going to change? That is the biggest challenge that we are going to face. So I hope this one just to give you a glimpse about what is about risk reward. Risk reward is not about investing in stocks and investing in bonds. Risk reward is talking about expected returns versus volatility. You want to have a high expected return with relatively lower volatility. Okay, and this graph I want to explain to you why safe is no longer safe. I've seen a lot of retirees' portfolio. A lot of them, they invest in the bonds with the banks. And moreover, a lot of them are actually doing leverage. They actually borrow money from the banks. The banker tell you, oh, now the interest rate is so low, you can borrow money to buy bonds. I can tell you, going forward, you are going to face big issues. And a lot of people actually already got margin calls in the past few months just because of the bond price drop. So this graph showing, which is called the U.S. Treasuries, which is called the safest asset in the entire Earth. And you see the U.S. Treasury actually fall down 21% in 8 months' time, 21%. So for the people who invest in bonds, right, you never expect your return to be falling 20%, right? So this is the thing I call that the expected return of fixed income already changed. It's already changed. So expected return for everything has changed. So you need to adjust your portfolio. Even if you have invested before, you need to relook at your portfolio, whether it still makes sense in the going forward environment. And how about Singapore? So this graph showing, which is called the APF SG bonds, is the ETF invest in Singapore bonds. And this is a CPF approved bond as well. Maybe you search internet, a lot of people say, oh, you just buy STI ETF with ABF ETF and do a rebalancing, blah, 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 something like that. And buy a whole for 10 years can make money. Let me show you. If you buy this bond, do you expect you will lose 10%? Do you expect you will lose 10% in half a year? You don't. So that is when people don't understand what is expected returns. They invest anyhow, and they think that, oh, we just buy something and hold, and it doesn't work anymore. And how about Singapore stocks? Singapore stocks, a lot of people have blue chip stocks. They always tell me, oh, we buy DPS, buy OCBC, buy UOB, never die. Some people buy SIA, buy Singtel. This is all the very, very common instruments people use their CPF to buy. But in reality, right, you see, this is a 10 years chart. This is not the 1 year or 2 years. This is a 10-year chart. If you were to be investing in Singapore blue chip stocks, this is the return you're getting. As of this week, we are slightly negative still in 10 years. So can you imagine that you are investing in something? If you invest in the stocks, which you hold for 10 years, you still don't make money. And these are all blue chip stocks. They are not speculative. So that's the problem that the people face when they invest, because they actually don't want to take a lot of risks. I know a lot of pre-retirees and retirees, your objective is not to take risks, but essentially you are taking a risk by investing the wrong thing. Why am I say so? Because you look at the opportunity cost of investing into Singapore stocks only. If you only invest in Singapore stocks, you'll be somewhere around here. If you were to invest in the US stocks, you make 200% return. If you invest in China stocks, you make 100% return. On average, global stocks, you are making almost 100% return also. So if your CPF for the past 10 years, you buy the CPF approved STI ETF or Singapore SGD bonds, you'll be somewhere around here. And does that help your retirement? You can even achieve even 1% rate of return for your CPF investment. And what if now is your time for retirement? Imagine you start your retirement planning over here and you invest in 10 years and you look at your portfolio, you are somewhere around here. Whatever you put in, it is what you can get. So this is the thing I keep on talking about. It's called asset allocation. If you only allocate to one single asset, you run the risk, even 10 years, you cannot recover your loss. And this chart is a very busy chart. You don't need to read the details. Essentially, it's ranking what is the best performing assets to the lowest. So the one on top is the highest performance, and the one at the below is the lowest performance for this period of time. This is called periodic return table, right? So ironically, Singapore stocks is the best performing assets in most of the global stock market in this year. But even so, you are still losing money in a 10 years frame. And this chart is trying to explain to you that every asset class perform differently in different years. And your job is need to understand that what class can perform better in the different years. And this is called asset allocation. And you can Google about this. This is called the investment clock. It will explain to you at the different type of the economic cycles, at the different inflation, interest rate environments, different asset class performs. So just now Ryan asked me about I think James asked in the inflation environment, what kind of assets can perform well. So you can refer to this clock. But again, this clock is based on historical data. As I mentioned, COVID-19 changed everything. COVID-19 changed everything about investment assumptions. So this table will be reshuffled as well. But at least this will give you a good start. This gives you a good start to understand, not everything perform at the same time. For example, last year, technology stocks were doing very well. If you buy Apple shares, you buy Microsoft shares, you could make quite a good profit, right? But since the beginning of this year, all these shares is quite flat. You can't make much. But instead, maybe the bankings, you look at the DBS shares. That's why Singapore stock market was doing very well, because Singapore stock market was a banking heavy. So if you look at this year, the financial sectors was doing very well because of the rising interest environment. So in order for you to do investment, you need to understand the impact of the macro environment to different asset classes. And that is how you can determine what's the best thing to invest. Okay. Lastly, I want to show you this one, which is explain to you why most people lose money in their investments. Because when you heard of something, for example, Tesla stocks or Bitcoin stocks, you are always here somewhere around here. That is when the most publicity, most people are talking about is during this new paradigm, the next generation things, and that is typically the time the things start to fall. That's typically the time start to fall. And if you look at the smart money and the institutional investors, they already plan their seats over here. And when you are keep on buying, they are actually dumping all their shares to you. That's why most people always lose money, because you will be holding these shares and you'll be even buying even more and more during when the share price start to fall. And that is a trap. It's called a value trap. So you think that this is good investment, you keep on buying it until here, and you will never be able to recover your loss. And these people will repeat the same cycle again. That's why investment actually go by cycles. In the very long term, actually it's a zero-sum game. If you are just buying and holding something and hopefully in the long run you can make money, you can, but typically the return is much smaller if you are able to do an active asset allocation. Yeah. So I want you to remember the trend is your friend. The trend, I'm talking about economical trends, micro environments. I'm not talking about trading, day in and out. I'm talking about macro trends. What is the themes for this era, for these 5 years, for these 10 years? And you need to position your retirement portfolio in the same trend. You don't go against trend. For example, newspaper is already moved to all digital news. And if you are still sticking with the traditional publishers, you may not be able to make money, right? Even telcos was not doing very well because all these new facilities, new internet providers, all these things. So you need to relook at your investments. You see whether you need to adapt to the new trends. Yeah. So with that, I conclude my presentation for the investment planning. And just to recap, this is what we have talked about today. We're talking about retirement planning in the first half, and then we talk about investment planning in the second half. And the first half, I explained to you what are the roles of CPF plan play in your retirements and how you should do your asset allocations. The second half, I talk about the most important thing about investing is that you need to identify what is the thing is trending, what is thing is suited with the current macro environments, and you should position your retirement portfolio to the same directions. And lastly, this is how you can contact me if you are having more questions, which is not answered to this webinar. You can join my Telegram, join my Facebook, or even email me if you have a personal question that you want to be answered.
Thanks, Ivan. So if you have more you want to ask, you can also put your comments in our comment box right now. We'll try to get to them as best as we can. And if you like our session so far, please give us a like so we know we're on the right track, and maybe we'll try to extend the session a bit more so we can accommodate more of your comments, because we are running short of time for today's session. Of course, CPF and investing with CPF is such a broad topic. If you missed our first session, you can also rewatch it on YouTube or Facebook. So go look out for it. And in the meantime, let's jump into the questions right now. So here's an interesting comment coming through from many of you. You don't realize that the buy and hold strategy is not really working out anymore, especially with the bonds situation. So let's say a question coming through from Gerald, and he's asking, with bond yields going up right now, is maybe time to revisit bonds?
That is why I call the value trap, you remember? Just now, maybe, can I share the slides again? Can I go back to the slide just now? Yeah.
10-year chart.
Yeah, this one.
Oh,
okay.
this one.
This is why I call the value trap. Bond investment have been performing very well for the past 20 years. Since the day the US start to okay, let's say 10 over years. Since the global financial crisis, the US start this thing called the quantitative easing, and they start to so-called reduce the interest rate at a substantial level. And if you understand bond investment, bond works as a reverse relationship of the interest rate. That means the lower the interest rate, the higher the bond price. So if you go to chart the bond has been running very big for this one. So now the interest rate is 0. So imagine that if the bond price, if the interest rate start to revert, let's say the interest rate start to going up, actually the bond price may be going for this path, That's why there's a panic selling recently. You see the 20% drop of the US Treasury yield, you see the 10% drop in the Singapore bonds. That is a panic selling. Yeah, because professional investors already realize that. So I would say that it's not say all the bonds cannot be invested, but then you need to know what you are getting into. Yeah. So I hope that explained to your question. You shouldn't just because the price drop, then you start to buy.
Yeah, so cheap can be cheaper, so you never know where it's going to end up. Yeah, and another question coming through from Mag Song. She's asking about what you should do. Is it wise to top up your retirement account to enhance your retirement account with your extra funds, or use your extra funds and invest it?
Okay, so if we go back to my first part of the session, if you need to look at your entire portfolio. How much is the percentage of your CPF comparing to your entire portfolio? If your portfolio is like your CPF is 30% of your portfolio, which is still manageable, maybe you are able to top up a bit more. Let's say the CPF is already 50% of your entire portfolio. Then you need to question that is it still wise to do so? Because then you'll be very concentrated into one particular asset class.
Okay, here's an interesting question, a bit different from the CPF topic. It's about how you choose your financial consultant. And let me try to get it up on the screen right now. This is around fee-based versus commission-based. What is the difference? And of course, Ivan, yourself, you are a fee-based consultant. What is the consideration here when someone is choosing between fee-based and commission-based?
Yeah, so I always believe that you need to walk to your talk. So I used to be a commission-based advisor. And about 10 over years ago, I chose to change to be a fee-based advisor. The reason is very simple. I think that there's no way a commission-based advisor is able to advise you neutrally from an investment point of view, which is very, very tough because we are all human beings. It's only when a fee-based structure, right? You are aligning your interests with your client, and you both have the similar objective, regardless about how which investment instruments you are choosing. So if you pay a flat fee to the advisor, then the advisor will not be tempted to sell you anything which is pay the advisor higher commission.
Ivan, I think that's all the time we have for today. And once again, everyone, thank you all for joining us for today's webinar, how, why, and what you can do with your CPF to do planning, more planning for your retirement. And if you missed our first session last week, you can catch it on Facebook or YouTube. And of course, this will also be available there. And if you like today's session, please give it a like so we know that we are on track to giving you what you want to listen to. Of course, please keep the comments coming through. I think if Ivan has some time, he'll also try to redo his replies on the Facebook post as well, where the comments are. And just a shout out to our newsletter. It's called The Weekly. If you want to find out more about Money FM 89.3, what we are doing in the week ahead, you can subscribe to our newsletter. So you can find the details on our website. There's going to be a button for you to click on. You can just click subscribe, and they'll inform you about what's coming up in terms of interviews, what webinars are coming up, and what market developments, personal finance events that you should be keeping on your radar. So that is something to help you with your personal finance decisions as well as your investment information as well. So we are also putting up a link for you to give your feedback. So there's a survey link for you to click on, and you can tell us what other topics you want us to address. And maybe if you want to hear from Ivan again, we can bring him back if he's available. So that is something we will be happy to do. So we'll be happy to have you back again for future webinars. So once again, everyone, thank you for joining us this afternoon. Ivan, also, thank you so much for joining us in the past 2 weeks. I hope everyone took away some interesting insights and learned something new as well. Ivan, thanks again, and we'll catch everyone again soon.
Thank you, Ryan. See you again.